Hi everyone, welcome back to another video. In this video I'm going to be giving you all an update on JD.com, and if you can remember, we covered JD a couple of months back and determined the stock was undervalued on a 5-year discounted cash flow basis. I then went on to open a small position in JD, which is still a relatively small position, but I may be looking to increase the size of that position given the continued downtrend of the stock since I bought it and published the video. It was also showing as one of the most undervalued stocks relative to its estimated fair value that I'd gave it on our Patreon watchlist tracker, which put it on my radar. And actually, I would argue that JD.com is one of the most undervalued growth stocks, along with its peers Alibaba and Tencent, in the market today. And in this video, I'm going to show you why I think that. So if we start here with JD's most recent results, quarterly results, this was Q1 2021, and I feel this is a good place for us to start because we want to look at and get a sense for if the business is improving and executing on its current business plan, and if it's executing on its plan that I have as an investor. So their business plan or strategy is obviously to grow into this vast China retail sales market and capitalize on the huge population of China and increasing online penetration. What's interesting is here they highlight in their Q1 results the fact that the Chinese market is still very fragmented, and the top 20 players only make up around 17% of the total sales number versus 52% with the likes of the US. This tells us that there is still room for dominant players like JD, Alibaba and Co. to continue growing into their total addressable market. Now, what's more is only 25% of China retail sales are made online, made through e-commerce. Now, not all retail sales will fall or fit into JD's business, but it does suggest to us that there is still a huge runway for growth in this industry. And looking at their results, what they actually achieved relative to this plan, they're executing on it brilliantly. This most recent quarter, they posted 39% revenue growth year over year, and that was made up of 35% in their core business, their product revenues business, and then 73% growth year over year in the net services portion of the business, which is made up of highly anticipated JD Logistics arm, plus their growing advertising services. Now, another positive sign is the improving profitability of the company. Of course, this is still a very low margin business, a very asset heavy business, just as Amazon's first party e-commerce business was for so long. They didn't make a profit for however many years. Now they're making a 6 to 7% operating margin. But with JD, they're seeing signs of improvement in the first party business through economies of scale and also through the growth of the advertising service business, which is, like I say, a low cost revenue stream. And it's important to remember, although 3 to 4% operating margins are far from impressive, JD has gone from producing 0% margin back in just 2018 to profitable through increased scalability, and looking like that margin will expand further with more scaled economics. But my one piece of advice would be not to focus too much on the margins for now. I feel what's important for JD at the moment is that they continue to invest heavily in their e-commerce and logistics network, because we saw earlier in this video the retail opportunity in China is huge and we haven't even scratched the surface yet. And so following on from that point, keeping the rapid growth of the Chinese market in mind, another reason I feel JD is one of the best value stocks to own in this market is its deep economic moat and competitive advantages. Now, economic moat is a phrase coined by Warren Buffett, which references a company's ability to fend off competition through different forms of competitive advantages. For JD, its core first-party e-commerce and logistics business, they have a number of advantages that would make it almost impossible for anyone to emulate their business model in a successful fashion or anytime soon. One big reason is the barriers to entry. To do what JD has done and build the network it has, you need a first mover advantage. As we've seen, JD's lost a significant amount of money for a sustained period of time whilst it's built out this vast and superior logistics network. And now, because of this, JD is able to deliver around 90% of orders on the same or next day through leveraging a network of over 1,000 warehouses with a total of 21 million square meters and 200,000 delivery people covering almost every district in China. This really allows them to focus on speed, quality, customer experience, things that we've seen contribute to Amazon being the business it is today. So I'd say this is a very unique position, and they're the only company that owns this type of network in China, and I'd argue they will still be the only company to own this type of first-party network in around 5-10 years' time. And with all that in mind, I think we can agree this is a business that is improving and has significant tailwinds. However, the market doesn't seem to think so. The stock is now down 35% or close to 35% since its high in February. Concerns maybe around China, geopolitical issues, and maybe some other factors that I'm not aware of are driving this stock down to levels that it doesn't deserve to be at, in my opinion. Now, I will take you back to the valuation that I did for JD in the last video. I felt this valuation was quite conservative. I only did 17% growth on the top line. This is a company growing at 30 to 40% currently. I did put in some fairly big margin expansion, up to around 7%, but I was accounting for the services revenues and other portions of the business that aren't as low margin as the retail arm. But anyway, I made a more conservative DCF analysis for people who weren't as happy or weren't as comfortable with the downside protection on this one. So in this DCF analysis, and by the way, if you haven't watched that first JD video, then go and do that as I explain why this earnings number here, this 7.9 billion and 7% margin, probably isn't necessarily an accurate number to project for the long term. And this is because there's a securities gain in there and a non-recurring item. I took that securities gain out and we have a more recurring earnings number, which is around a 3% EBIT margin. So we are taking that margin there and we are projecting it forward. So you can see the 3% margin there, but the main difference I've made in this valuation, this ultra conservative one, I'll call it, is the final operating margin or the final earnings margin of 5% in 2025. I've dropped it down to 5%, which I think, is easily attainable for a company like JD, especially if they're going to be at the size and scale that I'm projecting here, 250 billion in revenue by 2025. All right, Amazon's at around 6 to 7%. I think JD can do a very similar thing with their business. Now, I've also been conservative on the terminal value side, a 5% free cash flow yield. The reason I've gone with the 5% free cash flow yield, which is around 20 times free cash flow, is because they do spend a lot on CapEx. Therefore, the free cash flow number is a lot lower than the earnings number. And when the free cash flow number is lower, I like to use that as the base for the calculation, just because it adds an element of safety. We don't know what metric investors are going to be looking at in 2025 to calculate a fair value for JD.com. So I've gone with the lower one. Now, even with this, being ultra conservative, it still gets us, if we look at our DCF here, on a 15% required rate basis, just for the operating business at the moment. That gets us to around 116 billion for the company, or $73 per share, which is exactly the price that the stock is at today. So you'd say it is fairly valued. But what I want to do here is just add in that securities portfolio. I talked about the securities gain. We should account for the fact that they'll probably have somewhere in the region of a $23 to $24 billion securities portfolio on top of this. So if we want to, we can add this number in here. That will give us a slightly different number, slightly higher intrinsic value. The estimated intrinsic value somewhere between $73 and $79, with a very conservative forecast up here. So in summary, I would say JD.com is one of the most undervalued large cap growth stocks available in the market, and I will probably be picking up some more and adding to my position very soon, and I will let you know when I do that. As always, guys, this will be available on the Patreon to download and create your own copy. There are a ton of other valuations on there if you would like to get instant access to all of them and much more, like our Discord server. Then if you're interested in that, I'll leave a link in the description for you to go ahead and check it out. Other than that, I'd appreciate if you can leave a like on the video, subscribe to the channel if you haven't already. Let me know in the comments below what you think of JD.com, and I will see you all in the next one. Good luck with all of your investments.